So you found your dream home and you're expecting to go to closing in just a couple days. Or maybe you want to refinance your home and pull out a little equity. But one day you get the call from your mortgage banker. They pulled your credit report and learned that you have a tax lien. Because you owe back taxes, the IRS has filed a lien against you. But what about your new mortgage? Will you be able to close on your dream home? Can you get a mortgage if you have an outstanding tax lien? That's the topic of today's video on the other side of the break. What's up, guys? Corey Hankerson here from Legacy Tax, and they call me the Levy King because I have literally helped thousands of clients with unfiled returns, back taxes, tax liens, and that's right, IRS levies. If the IRS took your check, the Levy King will get it back. 1-877-LEVY-KING, LevyKing.com. I'm also the author of End the Tax Nightmare, Insider Secrets to Beat the IRS and Reduce Your Tax Debt. Inside the book, I show you how to stop IRS levies, liens, and garnishments without paying the tax in full, how to set up the payment plan that you want and not the one that they want, and how to potentially settle your tax debt for less than you actually owe. My book has been a top seller on Amazon for years, and you can buy it right now for $19.99. But I want to give you a copy of the book absolutely free. Just go over to my website, endthetaxnightmare.com, enter your name and your email, and you get a copy of the book right away. No charge, not even for shipping, totally free. Now, before we go any further with the video, I want you to take a moment to subscribe to our channel and don't forget to like us on Facebook and follow us on Instagram. Okay, let's dive into today's content. If you look around the internet, you'll find a lot of information and misinformation about tax liens and mortgages. A lot of so-called experts say that having a tax lien will prevent you from getting a mortgage loan via conventional financing rather. But that's not exactly true. The only way a tax lien will prevent you from getting financing is if you are completely ignoring it and just not paying the IRS. There are two potential solutions here. The first is set up a payment plan with Lien Subordination, and the second is Lien Release, Withdrawal, or Discharge. These tools are not necessarily standalones. They're frequently used together in various combinations to accomplish the homeowner's or the lender's goals. The most common solution is to set up a payment plan, known as an installment agreement. Then request lien subordination from the IRS. Lien subordination is where you get the IRS to agree to allow another creditor, the mortgage lender in this case, to hold first position above the IRS in terms of priority. That might sound complicated, but just understand that when a bank lends you money to buy or refinance a home, the bank secures the loan by placing a lien against the property. But when you owe back taxes and the IRS files a lien, they jump into first position, meaning that if the property is ever sold, the IRS will be paid first and the lender would only get whatever money is left over. Now, obviously, lenders don't like this and would rather prefer their lien to be priority. Subordination is typically done for refinance deals, not sales. A lien release is granted where you have actually paid the tax obligation or the obligation has expired and the IRS can no longer enforce repayment. When either of these things happen, the IRS is required to release the lien, but sometimes they fail to do so. You want to request a Form 668Z, Certificate of Federal Tax Lien Release, to prove to the lender that the tax lien is gone. Lien withdrawal is where the IRS issues a Form 10916C, which removes the notice of federal tax lien from the public tax record, even though you've not actually paid the tax debt. The debt still exists and the IRS's right to collect the tax is still there as well. Now, some lenders will accept this, but some lenders will not. You got to check with your lender. When the IRS issues a notice of federal tax lien, it covers all property owed by the taxpayer and all property the taxpayer may acquire in the future. A certificate of lien discharge, Form 669C, is where the IRS allows certain assets to be free from the lien. In my experience, a discharge is more common in situations where the seller owes back taxes and a tax lien is preventing him from selling his home. The IRS may discharge the home from the lien and allow the sale to take place if the seller's tax debt can be paid at closing or with the proceeds of the sale. Let's take a look at two of the most common types of home loans, conventional and FHA, to see how the tax solutions play out with each type of loan. With an FHA loan, if the IRS files a lien and the lien appears on your credit, the lender is going to require you to enter into a valid payment arrangement. Your lender will need to see proof of the payment arrangement to satisfy the FHA requirement. FHA will include the monthly payment to the IRS in your DTI. So you'll need to qualify with this now higher debt to income ratio. FHA requires that you make at least 3 monthly payments before you can close the loan. 3 payments means 3 consecutive months. You're not allowed to prepay these payments. The IRS must agree to lien subordination. In other words, they have to be in second position to the FHA lender in order for the deal to close. Now, one last thing about FHA loans, and all federally backed loans, that is. When you're applying for a federally backed loan, like a mortgage or even an SBA loan, they're going to check something called the Credit Alert Verification System, aka CAVERS. CAVERS is used to determine if you have any type of federal debt. So if you previously defaulted on a student loan, an SBA loan, or owe the IRS, you won't be able to get a federally backed loan unless you bring those old debts out of default status. So even if the tax lien doesn't appear on your credit report, CAVERS will probably get you jammed up. Conventional loans work a little bit differently. Conventional loans do not check CAVERS, so the lender is usually going to learn about the tax lien only if it appears on your credit report. With a conventional loan, you also have to be into a payment plan, but you do not have to make 3 consecutive payments before your loan can close. 1 payment is often sufficient. One big drawback, though, with a conventional loan is that the tax lien cannot be in the same county that you are purchasing the home in. Let me explain. When the IRS files a tax lien, it records a notice of federal tax lien at the county courthouse in the county where you live, according to your most recent tax return. If the lien is already filed in the county where you live, you're going to need to either switch to an FHA loan or have the lien released or withdrawn. As you can see, there are a lot of moving parts to consider when you owe back taxes and you're also trying to get a mortgage. If you owe back taxes to the IRS or the state, I want you to know that there are special programs in place to help you get a fresh start and get out from under this tax debt. But how do you know if you qualify? No 2 cases are exactly alike. So how do you know exactly how much you can settle for? Well, I've created a free tool to help you get qualified for a fresh start. Just head over to www.levyking.com or click the link below. Follow the prompts and answer a few simple questions, and we'll help you figure out your eligibility. That website again is www.levyking.com, or give us a call at 1-877-LEVY-KING. That's it for this week, guys. Talk to you later. Bye-bye.